We're going to review the freeandclear.com Debt Consolidation Refinance Calculator, which is a mortgage calculator that allows you to determine if it makes sense for you to consolidate existing debt by refinancing your mortgage. Our Debt Consolidation Refinance Calculator enables you to compare the cost of your combined existing monthly mortgage payment and debt payment to a new refinanced mortgage payment. The calculator allows you to understand if you have enough equity in your property to refinance your existing mortgage, pay off your high interest debt, such as a credit card loan, and potentially take cash out from refinancing. To find the Debt Consolidation Refinance Calculator, simply click on the Mortgage Calculators tab on the top left of any page on freeandclear.com, and that will take you to a page that lists all the calculators available on Free and Clear. The Debt Consolidation Refinance Calculator is located under Mortgage Refinance Calculators on the right side of the page. And if you click on the triangle to the right of the calculator title, it reveals a brief description of the calculator. I'm going to click on the title, which will take us to the calculator page. As you can see from the way the page is laid out, the inputs to the calculator are on the left side of the page, and the outputs to the calculator are on the right side of the page. The inputs are the information that you provide or select, and the outputs are provided by the calculator after you click the calculate button. I'm going to walk through the inputs and outputs one by one. It's important to highlight that if you ever have a question about an input, simply hover your cursor over the icon to the left of any input rectangle, and it reveals a brief description of the input and the information required. The first input is the original amount of your existing mortgage. So if you obtained a $300,000 mortgage to buy your home, you would input $300,000, and that's the figure I'm going to use in this example. The next input is existing mortgage type. This is the type of mortgage that you currently have, and if you click on the drop-down menu, it shows three options: fixed rate, adjustable rate, also known as an ARM, or interest only. I'm going to select fixed rate for our mortgage type in this example. The next input is the interest rate for your existing mortgage. This is your current interest rate, and if you do not know this information, you can either find it on your monthly mortgage statement or by contacting your lender. I'm going to use 5% in this example. The next input is the term of your existing mortgage, or the length in years of your current mortgage. If you click on the drop-down menu, it shows a range of options from 10 years to 50 years, and I'm going to select 30 years in this example. The next input is our current monthly mortgage payment. Based upon the inputs we provided, our monthly mortgage payment is $1,610. The next input is current mortgage balance. You've probably paid down some of the principal amount of your mortgage, and this is your current loan balance. Your current mortgage balance may be on your monthly mortgage statement, or you can contact your lender for this information. In this case, I'm going to say that our mortgage balance is $250,000, so we've paid off $50,000 of our original loan amount. The next input is the estimated value of the property you are refinancing. This input will allow us to determine if you have enough equity in your property to refinance your existing mortgage. If you are uncertain of the estimated value of your property, you can use websites like Trulia, Zillow, or Realtor.com to find a preliminary property value estimate. Please note that lenders typically require a formal property appraisal from a certified appraiser, and the property value provided by the appraiser may be different than the estimate provided by these sites. I'm going to use $400,000 for our property value. The next input is our existing debt amount. In this case, I'm going to say that we have a $30,000 credit card balance, so I'm going to use $30,000 for our existing debt amount. The next input is our monthly debt payment. In this case, I'm going to say that the interest rate on our credit card debt is 10%, which means that our monthly debt payment is approximately $400. The next input is the amount of your new mortgage, so the size of mortgage you're getting when you refinance. I'm going to use $300,000 in this example, which is the original amount of our existing mortgage. The next input is new mortgage type. This is the type of mortgage you are selecting when you refinance. Again, we have three mortgage options: fixed rate, adjustable rate, and interest only. In some cases, when you refinance your mortgage, you may change the type of mortgage you have, but I'm going to select fixed rate mortgage in this example, which is the same as our existing mortgage. The next input is the interest rate for your new mortgage. If you hover your cursor over the icon to the left of the drop-down menu, it shows the current interest rate for a 30-year fixed rate mortgage. In this case, the current interest rate is approximately 4.25%. You can use the drop-down menu to select whatever the interest rate will be for your new loan, and I'm going to select 4.250%. The next input is the term of your new mortgage. In some cases, when you refinance a mortgage, you may change the term of your mortgage. For example, you may go from having a 30-year mortgage to a 15-year mortgage. I'm going to keep our mortgage term constant in this example and select 30 years. The next input is non-recurring closing costs, or the one-time upfront costs such as lender costs, title insurance, escrow, and appraisal fees you pay when you refinance your mortgage. The lender should provide an estimate of closing costs when they provide a refinancing proposal. I'm going to use $3,000 in this example. The last input is recurring closing costs, or the ongoing costs you're required to pay a portion of at the time of closing, such as partial interest expense from the day your refinance closes until the end of the month in which it closes, and potentially prorated property tax and homeowners insurance. Again, again, the lender should provide an estimate of closing costs when they provide a refinancing proposal, and I'm going to use $1,000 in this example. These last two inputs give you a sense of the total closing costs required when you refinance your mortgage, although you may be able to include the amount of these costs in your new mortgage. We have submitted all of our inputs, and I'm going to click on the Calculate button, which will produce our outputs. The first output is our current monthly mortgage payment. The next output is total interest expense over the life of our existing mortgage. So this is how much interest we will pay the lender if we make the scheduled mortgage payments on our existing loan. The next output is our current monthly debt payment, which is pulled directly from our inputs. Next, we have the combined existing monthly mortgage payment and debt payment, which is simply adding our existing mortgage payment to our debt payment. The next output is our new monthly mortgage payment based on the inputs we provided for our new loan. And the following output is the total interest expense over the life of the new loan for our new mortgage. Next, we have the amount of debt we paid off by refinancing. In this case, we were able to pay off our entire $30,000 credit card bill. The next output is net cash out from or required for refinancing. In this case, because our new mortgage amount is bigger than our existing mortgage balance plus our credit card balance and closing costs, we were able to eliminate our debt and take out $16,000 in cash. So this is money we can put in our pocket or the bank by refinancing. Next is the minimum required property value to qualify for your mortgage. If you're taking cash out when refinancing, lenders typically require that you have a loan-to-value ratio of 80% or less. The loan-to-value ratio is the ratio of your new mortgage amount plus recurring and non-recurring closing costs to the value of the property. This is a way to measure how much equity you have in your property. In this case, the minimum required property value to have a loan-to-value ratio of 80% or less is $380,000. So we can compare this figure to the estimated value of the property that we provided in our inputs, and our property's estimated value is high enough to complete our refinancing. The next set of outputs compare our existing mortgage to our new mortgage and show the savings from refinancing. The monthly mortgage and debt payment savings or cost compares our combined existing monthly mortgage payment and debt payment to our new estimated monthly mortgage payment. In this case, we save $534 a month by refinancing and consolidating our debt. The next output shows the number of months to recover our non-recurring closing costs. So this is calculated by dividing our non-recurring refinancing closing costs in our inputs by the monthly mortgage and debt payment savings. Typically, you want to recover your non-recurring closing costs within 2.5 years of refinancing your mortgage. In this case, we recover our non-recurring closing costs in 6 months, so half a year. The final output is total interest expense savings or cost over the life of our new mortgage as compared to our existing mortgage. So you can see that we save over $48,000 in total interest expense in this example. It's important to highlight that you can change the calculator inputs without having to refresh the page. So, for example, if I change the interest rate of our new mortgage from 4.25% to 3.75% and click the calculate button, our outputs update automatically without having to refresh the page. And as you can see, our savings per month increases and our months to recover our non-recurring closing costs decreases because we lowered the interest rate for our new mortgage. After you have reviewed the calculator scenarios that apply to you, you can click on the Compare Lenders button at the bottom of the outputs and review a table with interest rates and fees for lenders in your area. If you are looking for a refinance proposal, make sure the refinance option is selected on the top left of the page. If you have any questions about the free and clear debt consolidation refinance calculator or any other mortgage topic, you can always click on the Ask an Expert button at the top of any page, and it will take you to the free and clear Ask a Mortgage Expert feature where you can submit your question. The feature is free to use and we never spam. We also encourage you to review the debt consolidation section in our free and clear mortgage refinance guide, which provides a detailed discussion, analysis, and example of refinancing your mortgage to eliminate debt. Thank you for reviewing the freeandclear.com debt consolidation refinance calculator.